Well, thank you for joining me at this week's weekly update. First and foremost, the Clay Shoot, June 16th. It's our 13th year raising money for MS. We're very excited to do it. Make sure you mark your calendars. Registration is going to be open very, very soon. If you have questions for future installments, I got two more that I got to try to answer here at some point. Try to find the right time. Uh, Go ahead and send them right here. This week's question, if you didn't see, the Michigan Consumer Sentiment Survey came out and hit a new all-time low. The market just hit a new high. Those things seem diametrically opposed. And historically, they are. Let's look at some periods. This is the Consumer Sentiment Index over the last 74 years. And you can see May 1980, right? A series of rolling recessions. The article comes out, the death of the equity. The 80s and 90s will be terrible. You'll never make money in stocks again. Now, we know how that actually turned out. 2000, right? January 2000. Oh, all you have to do is buy stocks. The consumer sentiment couldn't have been higher. We were about to enter a 50% decline in the market, right? And a huge decline in the NASDAQ. November 2008, right? The Great Recession, we hit one of these lows. Of course we did. The economy was rough. August 2011, the European debt crisis, we thought we were going to re-spiral back into it. Recently here, June of 22, right? The economy's in shambles. The market's down 20%. And inflation's over 9. All terrible periods, right? And then one in June 2000, everything was perfect. The economy moved against you in those ways. We hit a new all-time low. Yet the economy is still growing extremely robustly. From a market standpoint, we start out the year saying the market's growing, market's priced right now at about 22 times earnings. So you're paying $22 for a dollar of earnings, which is near all-time highs. And the market is expected to make like 12 to 13% in earnings this year, meaning the theoretical cap, unless you expect multiple expansion, is about 13% for the year. Today, right, we went through a little bit of turmoil there. The market's hitting new highs, but we're trading at 21 times. So we're actually trading a slightly smaller multiple. And it's expected that we might make something like 17% on earnings. So the market is growing at 17% on its earnings. We're actually paying slightly less on a relative basis than we were at the beginning of the year, even though the market is now higher. The economy seems to keep growing. The U.S. consumer is in better shape today than they ever have been. And yes, there's geopolitical turmoil. Yes, there's going to be some industry and some article talking about how something isn't going quite right. You can always throw a fly in the ointment and make the whole thing seem unappealing. Optimism is not easy. Pessimism is fairly easy. Pessimists is never disappointed. That's why I know I'm an optimist, because friends and family tell me I can be disappointed all the time. But realistically, no, optimism is not easy to come by. We think this metric might just be fundamentally broken. This might not work as a consumer sentiment. It just seems like pessimism is far too popular. So I want to remind people, we're looking at 5-10 year trends whenever we're doing investments. And people are asking me even recently about what do I think the last couple of weeks? And the answer is, yeah, we're seeing a broadening out in the general broader economy. We're seeing a broadening out of earnings across multiple companies. We're actually seeing a lot of positive news, and it's starting to play into a story that I think is going to take 5 years to tell. There's always something to be worried about. And right now it's Iran, but it was Ukraine not too long ago. It was tariffs last year. People seem to have already forgotten that. And yes, COVID was a huge deal. We all remember these things, but at the same time, we barely remember Ebola or Zika, right? Those things like flashes in our memories. But at the time, it was all anybody could talk about. And I want to remind people, yes, it's very easy to get caught up in the moment. It seems like that pessimism instinct for people is maybe higher than ever. And this metric isn't something we're going to be looking at very much in the future. There seems to be something fundamentally wrong with it. So I want to remind people to be generally optimistic. The economy overall looks very good. Can there be problems this year? Yes. Can there be market problems this year? Yes. We started out this year saying you probably need a couple of geopolitical headlines to drive the market down 10%. That seems like exactly what was happening. Yeah, there are still problems and issues facing us going forward, but on a 5 and 10 year basis, do we think things have fundamentally changed? No. I think things actually look really, really good, and on a relative basis, maybe even better than they did at the start of the year. So with that, I want to leave people with a general sense of optimism, especially from us. Speaking of optimism, book recommendation. Go ahead and see our book recommendation here. It's a fantastic book. And with that, thank you for joining us today. Very much appreciated. And hopefully you have a wonderful week.